Welcome to the Deep Dive, where we sift through the noise and pull out the key insights for you. Today, we're diving into a company making serious headlines, especially in, well, everything AI. Broadcom Inc., ticker AVGO. We've got the earnings reports, analyst takes, news, the works, really, to understand what's going on with this tech giant.
And it's quite a story. Broadcom is fascinatingly complex. It's really got two strong sides: semiconductors and infrastructure software.
Right.
So our mission today, essentially, is to get past those headlines. We'll look at the financials, the growth drivers, especially AI, but also, the potential hurdles.
Rates that might give you pause.
Exactly. And figure out what it all means for where they stand and where they might be headed.
Okay, let's get grounded first. A quick snapshot. Broadcom Inc., they design, develop, supply semiconductors, infrastructure software. Their stuff is everywhere.
Networking, smartphones, data centers.
Yeah, huge reach.
Okay.
Numbers. Last close was $306.10, but then, boom, a one-day jump of 9.41%. That's like $28.78, hitting $334.89.
Okay.
And the scale. Market cap is a massive $1.44 trillion USD.
Trillion, yeah.
Trailing 12 months revenue, $57.05 billion. Net income, $12.92 billion. They even pay a dividend, 0.75% yield, $2.30 annually.
Okay.
So right off the bat, you're looking at a tech titan. But that almost 10% jump, there's a story there, right?
Yeah.
What's the first read on those financials?
Absolutely. That jump screams AI excitement for sure. But digging a bit deeper, the underlying financial health looks pretty solid.
Okay.
For instance, debt to equity is 0.97. Pretty healthy means their debt is manageable, roughly equal to equity.
Good sign.
But what's really striking is the free cash flow, FCF. Trailing 12 months, $22.7 billion.
Billion with a B.
Yeah, that's a huge amount of cash generated just from operations after expenses. It shows incredible operational efficiency, a really strong foundation.
So solid base. But let's get to the exciting part, the AI engine, the semiconductor solutions segment. This seems to be where the fireworks are. Q3 fiscal 25, reported September 4th. Record total revenue, $16 billion. That's up 22% year over year. Pretty good.
Strong growth.
But inside that, AI semiconductor revenue hit $5.2 billion just in Q3, up a massive 63% year over year.
63%.
And it's not a blip. 10 straight quarters of strong growth.
Sustained momentum.
And the forecast. Q4 guidance is for consolidated revenue around $17.4 billion, up 24% year over year. And the AI part, expected to hit $6.2 billion, up 66% year over year.
Wow, acceleration even.
This isn't just growth, it's explosive, sustained growth. What is fueling this, really?
Well, if we connect this to the bigger picture, Broadcom isn't just, riding the AI wave. They're basically building the surfboard and the wave machine.
Okay, metaphorically speaking.
Yeah. Their dominance comes from a really strong competitive moat. They pioneered this XPU ASIC model. Think custom-designed AI chips, super specialized.
Right, ASICs.
And they've invested heavily in their own IP. Like SerDes is crucial for high-speed data transfer and advanced chip packaging.
Right.
This lets them build these highly optimized solutions for the big hyperscalers.
The Googles, the Amazons, Microsofts.
Exactly. They're building tailored hardware for the biggest players.
So what does that actually mean long term? Are they just suppliers or?
It means they embed themselves really deeply. These custom solutions make switching costs incredibly high for those clients.
Ah, sticky customer.
Very sticky. It creates this powerful, recurring revenue stream and a huge advantage over rivals. It leads to gaining more and more share within those key customers.
Okay.
And speaking of customers, there's the big one. The fourth major XPU customer. It's pretty much confirmed to be OpenAI.
OpenAI, wow.
Yeah. Over $10 billion in orders secured for Broadcom's AI racks. Delivery starts second half of fiscal 26, probably Q3.
$10 billion from OpenAI alone. That's huge.
Yep.
What does a deal like that actually change for them, beyond just the money?
Oh, it's massive validation. It cements their leadership. It's not just the revenue, which is, enormous. It shows that when the absolute cutting edge of AI needs hardware,
They go to Broadcom.
they go to Broadcom. It proves their tech can handle the most demanding stuff. And this deal should push their fiscal 26 AI growth even beyond the 50-60% we saw in 25.
So it locks in future growth and kind of de-risks things by adding another huge customer.
Exactly. It diversifies their top-tier client base while locking them in deeper.
And it's not just the compute chips, right? There's the networking side, too.
You're absolutely right to bring that up. That's another key piece. Their AI networking portfolio is really strong.
Like what?
Products like Tomahawk 6, that's a high-capacity switch, very low latency, power efficient. and Jericho 4, an Ethernet router for these massive data center clusters.
Okay.
And Broadcom is very vocal about their open Ethernet solutions being superior to proprietary stuff like, say, NVIDIA's NVLink or InfiniBand.
Why is that?
They argue Ethernet scales better, it's widely adopted, and the latency is proven to be super low, under 250 nanoseconds sometimes. Competitive with or better than the proprietary options.
So they're hitting both compute and networking hard in AI.
Precisely. It solidifies their critical role in building out this whole AI infrastructure.
Okay, so the AI engine is absolutely firing on all cylinders.
Yeah.
But like you said, Broadcom has another side, the software business. Let's shift gears.
Right, the infrastructure software segment. Mainly VMware now.
How's that doing? It plays a different role, right? More stability.
Exactly. It's the steady anchor. And it did well in Q3 FY25. $6.8 billion in revenue, up a strong 17% year over year, actually beat expectations.
Nice. What drove that?
A big part was successfully shifting customers to subscription models. That seems to be working.
Okay.
And they're seeing huge adoption of VMware Cloud Foundation, VCF. Over 90% of their top 10,000 accounts have licensed it.
90%. That's impressive penetration.
It is. And they're landing big names. Walmart picked them as a strategic vendor for virtualization. 9 of the top 10 Fortune 500 are committed to VCF.
So it's really becoming the standard in that enterprise space.
You can really see how it balances things out, provides a stable, recurring revenue while the semiconductor side is, driving the high growth.
Makes sense.
The long-term strategy there is basically helping those 10,000 customers deploy and run VCF on their own premises.
On-prem, right?
Yeah. So that drives growth through IT expansion, but also future sales of add-on services, security, disaster recovery, and importantly, AI workload support.
Linking back to AI again.
Exactly. VCF 9.0 is built as an AI-native platform. It supports NVIDIA's Blackwell, so it gives enterprises a real alternative to the public cloud for managing their own AI stuff.
Okay, so securing the base, deepening relationships.
Pretty much strong, sticky software revenue.
Okay, that provides a solid floor. But look, we need the balanced view. It can't all be rosy. There must be some areas giving investors pause.
Oh, absolutely.
So while that AI story is super compelling, let's talk potential speed bumps. What about the non-AI semiconductor business?
Right. Management themselves described it as a U-shaped recovery. Basically, it's slow to recover.
How slow?
Well, Q3 revenue for that segment was flat compared to Q2 at $4 billion. And they don't expect meaningful improvement until mid to late 2026.
Mid to late 2026. It's quite a ways off.
It is. This U-shaped idea means it hit bottom, it's flatlining, and the climb back is expected to be gradual, prolonged, not quick at all. So that raises the question, right? Is the market really pricing in this slower segment, or is everyone just dazzled by the AI growth?
Good question. Any other headwinds? Margins? Costs?
Yeah, a couple of things. They expect some gross margin compression in Q4, down about 70 basis points from Q3.
Why is that?
Mostly because of a higher mix of lower margin XPUs and also wireless revenue picking up, which tends to have lower margins too.
Okay.
And R&D spending is up. Operating expenses in semiconductor solutions rose 9% year over year. That's that investment in cutting-edge AI biting in.
Necessary spending, presumably, but still a cost.
Definitely necessary if they want to keep leading in AI.
Yes.
But yes, it impacts near-term profitability.
And then there's the elephant in the room. Valuation. Stock price, $234.89. How does that stack up?
Well, it's significantly above, say, our internal fair value estimate of $271.24 and our price target of $240.69.
Considerably higher.
Yeah. And you hear analysts saying things like, the company almost needs a cure for cancer to justify the current valuation.
Wow. Cure for cancer.
Yeah.
That's a pretty strong language from analysts. What's the takeaway from that kind of comment?
It really highlights how much future perfection, how much massive continued AI growth is already factored into the current stock price.
So high expectations.
Extremely high. It implies that the margin for error for new investors might be very thin. Any slip-up in AI execution or even just a broader market slowdown in AI spending could really hit the stock hard.
Makes sense. Anything else on the caution side?
Well, there's been a noticeable trend of insider selling in Q2 and Q3 this year. People like Director Justine Page, CEO Hock Tan himself, selling shares.
Insider selling. How should people read that?
Look, insiders sell for many reasons, diversification, taxes, whatever. But when you see a consistent pattern of selling, outweighing buying, especially when the valuation is already stretched, it's something to note. It doesn't automatically mean trouble, but it's, a data point worth watching.
Okay, so noted. Slow non-AI recovery, some margin pressure, high valuation, insider sales. Definitely things to keep in mind. But let's pull back again to the strengths. Despite those concerns, that underlying financial power we talked about, the cash flow.
Right. That's still incredibly impressive. Record $7.0 billion in free cash flow just in Q3, up 47% year over year. That operational efficiency is real.
And shareholder returns.
Still consistent. That quarterly dividend is $0.59 per share.
And leadership stability seems solid too.
Yeah, CEO Hock Tan's contract was extended through at least 2030, so you've got continuity there during what they're calling exciting times.
Which they certainly seem to be.
Absolutely. And at the end of the day, that ability to generate huge amounts of cash and maintain stable, experienced leadership, that's a strong foundation. It helps weather storms, even with specific segment challenges or valuation worries.
It provides ballast.
Exactly. It balances the short-term pressures against those long-term advantages in AI and software.
Okay, so wrapping this all together, Broadcom's incredible AI surge, the solid software business, but then you have the slower non-AI chip recovery, the really high valuation, maybe some insider caution. What's the final thought for you, our listener? How should you balance that amazing growth story against the current price and potential risks when thinking about long-term value versus maybe just market hype?
Yeah, maybe the core question isn't just if Broadcom keeps growing. It almost certainly will, given the AI demand. But how fast will it really grow across the whole business? And critically, how much of that future growth, even the optimistic scenarios, is already reflected in today's stock price? What does that imply about potential future returns from this entry point? And what risks are you taking on with such a highly valued name?
A lot to weigh there. What an incredible deep dive into Broadcom Inc. today. We've hit the AI highs, the stable software, those valuation questions, the headwinds, really covered the landscape.
Yeah, hopefully you gained some valuable nuggets, a clear picture of what makes AVGO so compelling, but also so complex in the tech world right now.
Thank you so much for joining us on this deep dive. Your engagement, seriously, makes doing this so worthwhile. If you found this helpful, if you got something out of it, please think about subscribing to the channel. And definitely hit that notification bell icon. That way you won't miss any of our future deep dives. It genuinely helps us keep bringing these kinds of expert analyses to you.
Absolutely. Until next time, keep digging into the details.